All right, and welcome back to Health Economics. So today what we're going to do is we're going to get into taxes and price ceilings. Now, we've talked about these things a little bit in the past, especially when it comes to taxes. But there, we mostly just did sort of a mechanical exercise in how these things worked. Today what we're going to do is dive a little bit deeper than we did before and discuss sort of how everything here actually influences decision making. Remember, economics is all about understanding human behavior and particularly how people respond to the incentives that they face. We want these incentives to be aligned with the best possible outcomes. As Adam Smith reminds us in his book, An Inquiry into the Nature and Causes of the Wealth of Nations, it is not from the benevolence of the butcher, the baker, and the brewer that we get our dinner, but out of regard to their own self-interest. For these people, the only way to make themselves better off is to provide you, the customer, with the best meat, the best bread, and the best beer that they possibly can at the lowest price they possibly can. In situations like this, economists would say that the incentives are aligned. In order to make myself better off, I must make you better off. Thus, in this framework, business or commercial activity in general is a service to society. It is not merely a means of how to make money. It is a quest to figure out how we can actually serve one another better than anyone else can. So let's apply this to the medical field. And let's say that we have a doctor's office with 100 doctors in it. Okay? Now, the doctors all join this practice, on their own accord, and they decide that in order to make sure that everyone is paid the same fair amount of money, what they're going to do is take all the revenue over the course of, let's say, the month that each and every doctor earns. They're going to pool it together, and then they'll divide it equally among all the doctors. Okay? And so let's make this really easy. And we're going to suppose that there are no technicians, no nurses, no assistants, etc., etc. If this is the case, how would individual doctors respond? And let's say that the marginal revenue is equal to $100. So in other words, every time a patient is seen by a doctor, the practice as a whole makes $100. So is the doctor that this patient goes to see likely to be willing to see the patient? First, if the doctor sees the patient, the practice as a whole will gain $100. But this doctor in particular will only receive $1 from seeing this patient, while the other $99 will go to the other doctors. So now we have to ask the question, do we think that the doctor would rather go home a little earlier or make an extra dollar? Can we imagine a scenario where the doctor might decide, nah, I'd rather go home? Well, of course we can. In a very real, but admittedly strange way, this is a lot like how taxes work. Now, in this example, we have a very extreme case where it's an effective 99% marginal tax on this person's income. And almost nobody would propose a 99% marginal tax on income, except for a few people, because pretty much everyone recognizes that this would create a pretty big, what we call a disincentive to work. Now, this idea that taxes might create a disincentive to work is an old one, dates back to at least the 1880s and the Italian public finance economists, but it was popularized in 1978 by a guy named Art Laffer. And it became eventually known as the Laffer curve. And his idea was fairly straightforward. If we plot tax revenue on this axis, and let's say the tax rate on this axis, well, if we tax people at $0, or 0% rather, we're not going to raise any revenue. All right, any number of dollars or activity times 0% gets you 0% revenue. But then he also pointed out that if we tax people at, let's say, 100%, so in other words, we tax all of their income away from above some certain amount, well, we're probably also going to raise $0 because very few people will actually work to provide the tax revenue. And so what you have is something that looks kind of like this, where there is a maximum point where tax revenue is actually maximized. Now, just to get into some of the differences between people who tend to be on the right and people who tend to be on the left, people who tend to be on the right tend to think, and this is broad strokes here, they tend to think that we are over here, that we are overtaxed. And if you actually lowered taxes, then you would increase tax revenue. And broadly speaking, Democrats think that we are over here. And so if you raised taxes on people, then you would increase tax revenue. Okay? Again, this is broadly speaking. There are obviously exceptions. There are Democrats who think we're over here, and there are Republicans who think we're over here. Okay, but broadly speaking, at least in the US case, this seems to be what everyone seems to be quibbling about when it comes to tax policy. Which person's right? I couldn't tell you. Turns out it's a lot harder to measure this than we think. But conceptually, at least, it seems to make at least a little bit of sense. Where we are on this continuum, who knows? I've drawn it such that the midpoint, like 50%, right, looks like the highest. Doesn't have to be. The highest point could be over here, could be over here. We don't know. Okay, so empirically, really hard to figure out where we are. But this might give you some insights into what's going on here.